Good afternoon, everyone. We're going to wait for half a minute to see how many people will join us live, and then we're going to kick off. Today, we're going to be discussing Tapline. I'm joined by Peter, who's a co-founder of Tapline, based in Germany, but he's going to share more about the story behind Tapline, how they actually managed to get hold of SaaS companies, but also people on the side of the financing to help those SaaS companies with their current working capital needs. This is being recorded and we're going to post it afterwards. So everyone that's willing to share in the questions and answers section, please go ahead and do so. All of the documents are listed on the page, on the company's page in SeedBlink. But if you have any other requests that you might consider, please share them with us in the chat section here in Zoom. I think without further ado, we can kick off and then people will be able to join afterwards, right? Peter, thanks a lot for your time. I'm gonna start with the basic questions. I'm sure you don't need preparation for that, but first of all, how it all started. Who are you and how it all started? I think it will be very interesting for our audience.
Sure thing. That's a great question, actually. So myself, Peter Gruev, I'm originally from Bulgaria, but I spent about 12 years plus in the US across varied investment banks, effectively portfolio management, risk management, credit trading, structured portfolio, structured credit. So all sorts of instruments that are making you anything from 3 to 5% return. And, you know, you're dealing in like block sizes of 50 million, 100 million. BlackRock comes in, wants to invest at something at 3.5%, and then you structure up different pools. So effectively, structured finance is my background. And then a few years back, got in the family and kids business and wanted to also explore a different career. I left corporate banking and wanted to get deep dive into the startup ecosystem, and we relocated the family back to Frankfurt. My first project, and that's how I ran into my co-founder, Dean. Here, I don't know if you guys see my screen, but happy to share in terms of how we kicked this off. So late 2021, Dean and I had worked together for about 3-4 years. Our first project was we joined a company called Green Tech. It was an accelerator and venture builder focused on African startups. Within it, while not having direct ownership, I came in as a partner to structure the Africa deployment and sort of structuring for startups. But over 3 years, the interesting part is I spent time working with over 35 startups. And the one thing that was very, very clear to me is it takes 6 to 9 months to fundraise even 100K for like a little startup that actually is very successful, regardless, fintech, SaaS, agri-tech. So we work with companies in Kenya, Nigeria, South Africa, etc., structuring their business model and then helping them run their CFO, their fundraising, etc. And we pulled in a vehicle in Mauritius, and then when Corona time hit, we weren't quite as successful in being able to raise an impact fund for Africa, simply because a lot of the startups were just the continental sort of trade was very hard to pitch to new commercial investors, and we were basically at the mercy of the two development banks, German development bank, French development bank, and we were not able to put together 30 million VC fund with an impact focus on Africa. So Dean and I got together and said, well, look, what do we learn from this? One facility I operated was a 3 million euro, 50K ticket max size, operating working capital loans for these companies. So I was deploying on behalf of the French development bank, and I was sending tickets, you know, 50K in Kenya, 50K in Nigeria. But the net of it is, it was a very, let's call it, uneconomic exercise. It takes me probably 3 months to run a due diligence on a startup in Nigeria. You review spreadsheets in Nigerian currencies. You fly down in Lagos. You sit down with them. So you're deploying a 50,000 loan, and then you're billing the French development bank 30,000 for the consulting service to run the portfolio and manage the risk. Obviously not very economic. So Dean and I said, well, hold on. We've learned a lot. A lot of SaaS companies are out there. We need to find a way to quickly analyze their tools, understand their financials, and turn around quickly and be able to give them an appraisal and effectively give them liquidity in a non-equity form. So in 2021, we left Green Tech and we basically joined Antler Ventures in Berlin. They sort of helped us get our co-founder. Dean and I cover each other. So the two co-founders, we complement each other from a business standpoint. I'm more on the risk management and institutional fixed income. Dean has been in Germany across Commerzbank, Sanlam back in Cape Town. So investment management, but really more on sort of the sales, working with clients, etc. We needed a product guy. So we went to Berlin for twofold. One, to bring in a technology product guy to help us structure all the calculators, all the backend data draw, and also sort of like rebrand ourselves. Because spending 3 times in Africa, you're sort of not really talking to the right investors. 1, 2, the market was just a lot bigger. The year we left the African market in 21, Africa saw only 2 billion, the entire continent of 2 billion VC investing, whereas Germany alone was already getting 8 to 10 billion per annum. So we said, okay, this is our target market. Let's start in Germany. Initially, we sat down in the summer, we got the investment from Antler, and we basically started modeling, like the first trades were getting done in a spreadsheet. I worked through the credit model and I said, well, hold on. RBF is starting to take up a little bit. You had pipe and cap chase in the US. You had a couple, like a guy in France, in UK. E-commerce was sort of the low-hanging fruit because e-commerce lending was exploding. But from my standpoint, understanding risk management, I was like, well, hold on. What is one sector that I'm more comfortable predicting cash flows to have like target of 0 losses? Having worked with SaaS companies, what I saw is the ability to look at forward contracts and the lock-in that comes in when you're working with a B2B enterprise type revenue businesses. It's a lot easier for me to say, hey, you have $1 million of revenues, and these are very sticky revenues because you're working with German clients, BMW, Mercedes, you're selling to the German corporates, and your contracts are locked in for the next 1, 2, 3 years. So we decided, okay, let's develop a niche sector, be able to quickly underwrite for SaaS. We interviewed over 20 companies that summer, and by the end of it, basically our calculator tool was able. We use effectively open banking was our main innovation. We relied on the PSD2 innovation in Europe that basically, if you want a loan from us, you have to allow us to look through your bank. We use Go Cardless. They're basically our open banking provider. And if you want a 100K loan, we send you the link. We basically need to be able to look at your cash in the bank, monthly average burn, and we run it through the cash flow liquidity calculators to sort of estimate what is the probability for you to repay given your historical 1 or 2 year performance. But this was real-time analytics. Because of this, the European open banking laws that came in 2020 effectively allowed us to very quickly work with a provider. And now we're covering over 3,000 bank providers across Europe that allows us to draw banking data and effectively have real-time look-through. So this was the one side. The other one, and really the strength of our model, was building around the innovation in subscription analytics. As of today, we've actually built over 18 APIs that are linked to popular subscription software management systems like Stripe, have anything from a large B2B enterprise client with a 100,000 euro contract that is selling to BMW, all the way out, you have someone like Netflix that basically is what? Effectively selling 9.99 euros per month subscriptions to 1 million people, right? Being able to look through in between, decide which are the good SaaS companies that can repay your loan is obviously the important part. So for us, over the past 2.5 years now, we have built very robust analytics that are driven by these invoicing and subscription software management systems. So you link to us, you give us your Stripe data, and we very quickly know, are you a B2B enterprise client and you have 100 subscribers paying you 10,000 per annum, or do you have a 5,000 retail B2C and you're selling subscriptions for pet stores to basically sell sort of, managing your sort of cats and dogs software, when to send them to the vet, etc. So the variety of businesses that we can cover effectively gives us the ability to still use all our backend calculators based on banking and subscription invoice analytics. But over time, we continue to service a very wide area of types of clients. Today, obviously, we've been able to fund clients in the anything from $500,000 up to $3 million in annual revenue. But our ultimate goal is we work with different lenders as we expand our business and our facilities and lending lines. We hope to be able to basically go in the upper ticket sizes like 5 million, 10 million loans, etc.
Great, great intro. I'm sure a lot of questions will pop up from this. So right now, what is the business model? You finance, what is the range?
Okay, absolutely. Great question. So we basically are focused on SaaS companies in the following jurisdictions. We've worked and had BaFin approval, that's the regulator. We work with 80 to 90% of our portfolio is in Germany. So Germany is our main jurisdiction. Last year, we've onboarded a couple of VCs in Poland and Czech Republic, and this allowed us to expand in what I call blue ocean market. In Poland, Czech Republic, Estonia, there's very few people doing this. In Germany, we have one or two competitors, but in the other jurisdictions, we actually think that there's, the market is really completely open for us.
Is there regulation that leads that?
Yes, the way we approach, so our lender, we're very excited because we moved our facility from before. Each time we onboard a company, it takes us a little bit of time to onboard a new company. Right now, we have a dedicated lender. They're a hedge fund in the UK, and basically they want us to a lot more aggressively penetrate the entire, let's call it east of Berlin play, simply because CapChase and Pipe are not touching anything sort of Germany and let's call it Central and Eastern Europe. So our ultimate goal actually is to capitalize and continue to play in jurisdictions that are less well understood, simply because if you're a SaaS developer, you build tools, you're still selling to Germany, UK, and the US. Our ability, we now have over 500,000 subscription data points per month that we're analyzing, that we continue to grow our data sets. Basically, for us, it's less relevant as well as for our investor. If you sit in the Czech Republic, Bulgaria, or Estonia, we simply want to evaluate for good SaaS businesses, and effectively 90% of these revenues are coming from Western Europe for the time being.
Okay.
So back on the business model question, the reason we actually sort of maybe I can find one slide here. Do you guys still see my screen?
Yeah, we do.
So we basically changed our business model. Until today, the one thing that we found is a constraint for us is we originally had a lending facility where for every million, we had to put in 15% of our own capital. So Tapline was positioned, and the reason we deployed only 5 million to date, we basically were deploying 500,000 had to come from our own effectively equity and pockets. So when we looked at this summer to fundraise, the old model was actually not scalable. Venture capital, to grow equity, you want to minimize the amount of first loss that you're putting in. So today, we found a lender who is very happy with our model, and we now have 100% advance rate. What this means, for the next 10, 20, 30, 50 million loan book, we don't need to be concerned about raising capital from equity shareholders. So the only equity we're raising is basically for OpEx and marketing and expanding our analytics. But historically, we found this was a very big capital constraint for us. So last year when we raised $1 million, we literally had to set aside $500,000 was for direct investment into the portfolio companies. And over time, you're just very quickly running out of money. So basically, if we had stayed with the old model, for us to deploy 20 million, we should have raised another 4 million in equity, which basically goes in this first loss piece and is earning shareholders only 20-25% return on equity. Whereas right now, we have exponential growth and very high ROIs simply because as shareholders, we basically are borrowing and working effectively as a broker for this large fund. So right now, what we have is our first target is to deploy the 20 million facility. We act as a broker. The way that the money gets passed through to us, we basically have a dual revenue model. We're booking from the fund, we're booking 5% from the IRR, and we're levying another 2% commission to the SaaS company. And then, so the good news is this is upfront revenue. Each month we execute trades, we get revenue from the fund. Additionally, when we manage over the whole funnel of 1 year, at the end of the year, we get around approximately 1.5% performance fee. So effectively, With the lender, we continue to deploy trades. We get cash upfront based on the execution. So for example, if this year we deploy 20 million, we basically are going to book revenue of 1 million. Then at the end of the year, we look through our analytics and waterfall paydowns. If we have 3% losses, the securitization SPV vehicle, the lender runs the numbers and says, okay, you guys made 8% net return for us as a fund after funding cost. And then let's split 80-20. They keep 80%. We get a 20% of the net interest over a hurdle rate. So approximately this equates to 1.5%. So each year end, if we manage to bring deals that have very good loss-adjusted returns and losses are not outside of the pre-agreed ratio, call it 3%, basically we also would benefit to clip another 1.5% fund performance fee at the end of the year. But the way we're focused right now, again, we're looking to deploy, we're looking to onboard 150 clients this year. Marginally, we're expanding to get more clients.
How many clients do you have now?
Right now, we basically have, okay, these numbers are, we have deployed 64 trades. We have close to 30 clients. So 30, in terms of unique clients, we have 30 clients. The good news is, on average, they take 2 or 3 loans from us. So for example, last year, we have 56 financings across 27 clients. So you can see the ratio. Basically, the average client comes in on a recurrent basis. And that's why we're pretty happy to maintain our client acquisition costs while we look for new clients. Oftentimes, clients that have taken a loan, 3 months, 6 months later, they come back and they're saying, okay, guys, can I take another loan from you? Pretty happy with the experience. What is our new credit limit that we can borrow against?
Question that I received over the timeline of the actual campaign. What is the difference between yourselves? You called yourselves brokers, right? But where does factoring come in?
Mm-hmm. Super. So, okay, this is a very deep dive legal question. The reason we are actually, the reason our lending note works in this format because we use a legal construct that allows us to have true sale. What true sale means, it's a non-recourse purchasing of receivables upfront at a discount. So the math gets a little bit more complex, but just to illustrate, effectively our historical return last year on a pure IRR basis is north of 20%. But the way we basically are actually working is it works very similar to factoring. We purchase 12 monthly MRRs. And let's say you're an SME, you come to us, you want a 100K loan. We run the numbers. We effectively are linked in the back end. We're linked to your receivables. We validate the contracts, the monthly repayments, MRRs. And our offer to you is actually we're purchasing 100,000 euro, which is 12 monthly MRRs upfront at a 10, 12, 14% discount. So the legal construct works like factoring, but we actually have innovated on the legal front materially because typical factoring is not a very good product journey. Factoring would involve a trifactor or tri-party agreement where the lender, the debtor, and the seller are going in and passing in contracts. We actually don't do this. The SaaS company is the only one that have a contract with us because we're using silent assignment. The jurisdictions we've worked with our lawyers, we've been able to effectively create a construct that allows us to take collateral ownership of all these 12 monthly subscription receivables without having necessarily to bother our SaaS client to go around and effectively tinker around and, so if they're selling to BMW, good for us. We have great receivables that are pledged to us, but we don't need them to bother up front to call BMW and say, hey, Tapline is going to collect from you 10K per month, right? So our job is very user-friendly. We would obviously only have recourse and go after the third party if the SaaS company blows up, which until now we haven't had.
Got it. So no recourse at the moment.
Exactly. The SaaS company, basically, we're linked to their bank. We're linked to their Stripe. and their receivables. Contracts are all bought and purchased and pledged to us. And whenever we have issues, we're basically working directly with a SaaS company.
I have a question for you. Do you have a client from Eastern Europe, like Bulgaria, for instance? The question comes with the knowledge that here you have to make that assignment explicit, so it cannot be a silent one. So
that's why we reviewed the legal in Bulgaria. In some jurisdictions where this is required, we're taking a pause until obviously we sort of like prove the new model, and then we'll start rolling out. Look, guys, going to a new market, the legal fee it's 25 to 50K. Like that's one problem. Some jurisdictions are very easy and don't have this mandate. The country you mentioned in particular, there's a few. It's a bit more expensive to like go through all the legal agreements. So yeah, basically our contract is transferable fairly easy in some jurisdictions, and somewhere we just need more legal fees. And it's a question of, okay, if there's 100 million SaaS companies that are piling up to take a loan from us, we'll pay it. But if there's only 3 guys that need a loan, we just need to pace ourselves and obviously be cognizant of our fixed cost before we jump on a new market.
Got it. The majority of your clients right now are coming from Germany. Therefore, my obvious question is, where are you going next?
In Germany, we have seen actually a substantial pullback over the last year and a half. I think originally, like the bigger guys from the US, Pipe and Chase, Cap Chase, were sort of in and out, and basically they never really took a stab at the market. So we're actually seeing more applications coming to us. So for us, I think we're sort of more gradually, if pipeline comes to us, we'll look. But we're sort of really consolidating in these markets until we obviously sort of break even and look at the P&L and decide, okay, do the numbers make sense? So I would say our next markets are low-hanging fruit are maybe the bigger ones, like I would say Romania. Bulgaria, we've chatted with 2 or 3 accounts, but the national bank there, we need to kind of look at the workaround. So I would say countries that are easily legally to buy receivables, or a bigger market, someone like Romania, for example.
How do you estimate the Romanian market? How big is the size of the market of the receivables, SaaS receivables?
Talk to guys, basically tally up, look at GitLab, Crunchbase, download the SaaS revenues, buy a couple of databases and call the VCs. And usually we work with partnerships. So we'll call the local VCs and say, okay, do you have, show us 10 to 20 clients. If there are 1 to 2 million funding needs, okay, we have a 20 million pipeline. Then we basically go back and say, okay, let's reach out to the national lender regulator and then see if it makes sense to put a 25 to 50K, expense around it.
Got it. We talked at length about the business model. Can we share more data about the current round? Who's in it? What's the structure? What do you aim to achieve with the money that you collect?
Absolutely. So we actually in December we closed $1 million.
Could you please enlarge this, because we actually see your desktop as well.
Okay, got it. That's funny. Our goal is basically we actually clocked in around $1 million. Our goal is to raise a 1.2 total. In December, we had a lead from the MENA region. They basically are a family office. A15 is the affiliated VC, but given that we're outside of the geographic region, we actually ended up working with the family offices that are around it. And we also have German angels that are participating in the round. So what we, obviously we're pretty excited to sort of work with you guys. I think working with a crowdfunding platform, this sort of gives us more product and client exposure. So I think for us, again, we are open for up to 200K with this round. Month end is the round. The second closing is, as I mentioned, first closing, we closed about $1 million, $5 million pre-money. The first closing is done, 200,000 are open. And for us, obviously being able to engage with a wider community, the reason is really marketing, guys. I think being able to sort of source SaaS companies in the region is really a lot more prominent, sort of understanding the local structure, locking in partnerships with accelerators, with angel clubs. For us, this is a lot more efficient way to source clients. For example, in the German region, half of our client is different marketing channels, cold outreach, sales, etc. But around half of it also comes from effectively partnerships, referrals. We have partnerships with accelerators, angel clubs, VCs that cover SaaS space. And for us, it's a very cheap client acquisition channel. Generally, VCs and angels are pretty happy to work with us. We provide liquidity, and guys that are already in the deals are obviously even more excited to basically pair up on a deal. If you have $1 million seed round, they obviously will be pretty happy to sort of lower dilution, lower the seed round from $1 million to 700, and open up $300K for us as a non-dilutive funding.
Got it. I'm going to share something also in terms of the investment terms details. It's a convertible loan agreement. It's 24-month duration as far as I'm concerned. We've structured the 5% annual interest and 10% discount, but you guys can see more details in the landing page of Tapline. Okay, can you share a little bit more about the cap structure? That it's the current one. You said a family office is leading the current round, but who's already on the cap table?
Sure. We have regional VCs, so Antler Ventures. We have Black Pearl, they're Poland-based, one of the larger VCs there. We worked with 2 Czech Republic-based VCs. We have a couple of Bulgarian investors, as a matter of fact. They're local-based.
Private?
Sorry?
Private or VCs?
VC
Angels or
oriented,
VCs?
and I believe one of them is also a Bulgarian stock exchange listed fund that's looking for opportunities. So fintech players, obviously we try to cover the vertical.
I was asking who is on your cap table from a Bulgarian perspective.
Sure. Impact and MFG.
Okay, thank you. I see Galina is actually joining us. I don't know if she has any questions, and Dennis as well, because we still got a little bit more time. Guys, now's the time to ask questions. Otherwise, again, you will be asking me questions that I need to direct to Peter. But that's cool. Peter, have I missed anything more that you want to share? Yes, that's one of my questions. So what are you going to do with the money?
Okay, yes, absolutely. So we now are targeting effectively expanding 2 channels. One, being able to build the AI-driven analytics. We have a couple of minor roadblocks. So for example, our ultimate goal is to have 100% plug-and-play analytics. In Germany, for example, and actually it's funny, in Poland and Czech Republic, we see more SaaS companies are using tools, the standardized financial accounting tools, etc. In Germany, for example, we have one roadblock on the accounting side that causes a lag. The accounting software in Germany, DATEV, does not provide an open API. And effectively what we're building around it, so we rely on 3 analytics pillars. I have real-time data on bank and revenues. On the expenses, we have a little bit of a lag. So if you're a new client in Germany, the way we've built is we have OCR. You basically submit your Excel or PDF accounting, and we basically scan the PDF through an OCR and generate a time series internally. These Excels come in fairly different and varied formats. So for us, we're throwing a little bit more analytics, clean data, organized data, and make sure that our metabase, our data lake, is consistent in standardizing a standard P&L ledger. Historically, we had rendered CODAT, which is a accounting infrastructure layer that propagates this. But unfortunately, in the beginning, when we built the solution, CODAT really only covers UK. Less people are using these standard tools in Germany, like Hero, QuickBooks, FreshBooks. So for us, we still built our analytics on 2 out of 3 pillars that are real time. but we need to upload accounting in a deal room in the back and generate time series. A lot of dirty data comes in that doesn't recognize always, depending on the client format. So some of the money is going to go through a couple of financial analysts and credit analysts to clean the data, build the data set, and effectively, ultimately, by year end, we want to be able to build more and more data analytics towards next year. We hope to be able to start actually having enough data for a true layer ML model. Right now, we have enough, 500,000 subscription data points per month gives us enough repayment points, but we've only executed, 65 loans. It's too early to call it a machine learning, self-learning model on our own loan platform, right? Our model is dual. It relies on subscriptions, but we have insufficient data to be able to transition towards machine learning components. So we basically are building the analytics, and the second layer is SDR. So sales reps, right now we're beefing up the outreach in Germany, and we're gonna localize, probably look at someone in Czech Republic, Estonia. So literally the fundraise is half analytics, half sales.
Okay, in terms of actual run line, how much months will that secure you?
We basically are, this is 9 to 12 months, depending on when and how quickly we hire. But our goal is obviously to reach profitability by year end, so that this opens us up for a larger fundraise and really get the numbers very close to home here.
Got a question from Galina. Thanks a lot, Galina. How do you manage the risk of your liquidity being pulled out?
Sure, we are, great question. We basically, there's more lenders that are coming around this space. So when we negotiated this new facility, we basically had 2 more term sheet offers. Unfortunately, they were in the old risk structure where we need to commit like anything from 10 to 15% first loss risk sharing. A lot of these lenders now realize that 100% forward flow is the new game in town. And we actually think we have the ability to sort of continue to work with other guys. So in case we sort of get stranded here, I think we should be able to turn around and get like more guys on board over 1 or 2 months turnaround time.
Thanks a lot for that. What is the default and or loss rate up to today?
Yes, I mean, last year we had fairly small numbers of, like on 60 loans, we had 3 non-performer loans, and 1 of them is going through loss. I would say the average number at the portfolio level is around 2.5–3%. Going forward with the new investor, they're a very large SaaS lender with experience in the States and UK. We're targeting to shrink this materially. But going forward, our target is basically 3% annualized cum loss on a go-forward basis.
Brilliant. Thanks a lot. I don't see any open questions, and we are right on time. Thanks a lot. That's perfect timing. Thanks very much. Guys, again, I mean, this doesn't have to end here. We have a Q&A section in the landing page of Tapline. So should any questions come to your mind, please post them there. I'm sure other investors will also be thinking about those. So that will help them make an informed decision as well. Thanks a lot for your time, Peter.
Anytime.
Thanks, Galina. Thanks for the questions, and also thanks, Dennis, for being part of this.
Very good one, guys. Thank you.
Thanks. Bye.